Welcome back to the deep dive. Okay, so earnings season is wrapped up, the dust has settled from the FOMC meeting, and now we really need to look hard at the market dynamics for November 2025.
Yeah, it feels like the board has been reset a bit.
Exactly. And the environment, it feels different. Our mission today is to really dig into that, cut through the noise, and figure out, where's the path of least resistance for capital right now?
It's a really critical time, actually, because we're heading into what the data calls a slow period.
A slow period. That sounds not great.
Well, hold on. Let's be super clear for you listening that slow is only about volatility, not returns.
Okay. That's a huge distinction.
It is. The sources are pretty unified on this. The phase of those massive jarring volatility spikes, that seems to be over structurally.
Right.
And that change, well, it potentially sets the stage for sustained, maybe even powerful upward moves.
Okay, that sounds much better. Less stomach churn, maybe. So let's unpack this shift then. What's really driving this potential for stability and maybe a strong push into year-end?
It looks like three main things are lining up almost perfectly right now.
Okay.
You've got powerful seasonal trends kicking in, the usual November strength. Then there's the reopening of corporate stock buyback windows. That's huge.
Was a big factor, yeah.
A massive tailwind. And third, the technical signals. They've just clicked into place across basically everything: equities, crypto, commodities, even Forex.
And those technicals, I assume we have to start with volatility itself, the VIX. That seems like the anchor for any bullish idea.
Absolutely. We have to start there because it really dictates risk appetite, doesn't it? Our research pinpointed an inside monthly candle failure on the VIX chart.
Okay, an inside monthly candle failure. Break that down a bit for us.
Sure. So it's a specific pattern. It means the price range for the last month was contained within the range of the month before it. And crucially, it failed to break out convincingly in either direction. It often signals a kind of exhaustion and reversal.
So the upward momentum in VIX basically stalled out.
Exactly. Think of the VIX like the market's fear gauge, or maybe its speedometer. If that gauge, that speedometer, starts dropping fast, it implies the market is moving more smoothly, more predictably, probably uphill.
Makes sense.
And the technical structure now suggests this fear gauge should deflate, maybe significantly, through November.
Which inversely means?
Inversely implies the S&P 500 should move up. Less fear, more buying.
Okay, clear logic. Less panic, more marching higher. But, VIX deflation, market moves.
Yeah.
It always brings up one of the trickiest things for traders: gaps.
Oh, yeah, market gaps.
Those places where the price just jumps between sessions. It feels like that's where a lot of people, especially retail traders, get tripped up.
They really do. And the key reason is that you have to know what kind of market you're in, a bull market or a bear market. The rules for how gaps get filled, they completely flip.
They invert. Okay, so let's take the current situation. We seem to be in a pretty strong uptrend. What's the rule for gaps in this kind of bull market environment? Especially those bigger gaps, like on a 3-week chart.
So the rule here is actually kind of counterintuitive. When you're in a powerful, sustained uptrend, those gaps, especially the higher time frame ones, they can just stay open for months.
Months? Really?
Yeah, 5, maybe even 6 months isn't unusual according to the data. So the absolute key takeaway is do not try to fade them. Don't short the market just because there's an open gap way below.
So you just ignore it for now?
Pretty much. Those gaps, those inefficiencies, they tend to get resolved only during the next big cyclical downturn. For now, you ride the trend.
Okay. And I assume the opposite is true in a bear market then?
Precisely the opposite. Let's say the market's already down hard, like 20%.
Yeah.
If you get a gap up on some good news,
you fade it.
You generally ignore it or fade it, yeah? Because in a bear market, volatility is high. Those bullish gaps tend to get filled really quickly. Trying to buy that kind of gap up in a downtrend is usually, well, a painful trade.
Right. Okay, this is fascinating, though. There's this related idea, the bottom principle. You flag this as really crucial knowledge about market structure.
It really is foundational, I think. The data analysis is quite clear on this. The market will almost never form a true, reliable, long-term bottom if there's still an open gap below the price action.
Never. That's a strong word.
It's a very high probability statement based on history. That lower inefficiency, that gap, it basically has to be filled. Institutions need that clean slate, that resolved price action, before they feel comfortable really committing capital for a major U-turn.
Wow. Like a prerequisite for stability.
Exactly.
Okay. So volatility dropping, liquidity coming in from buybacks, gaps below us being ignored for now. It all seems to point towards equities,
Yeah.
specifically the NASDAQ.
Yeah, let's pivot there. The tech index. Because the outlook for November, based on the sources, looks exceptionally bullish. And a lot of that is driven by those seasonal forces we mentioned.
November seasonality.
Yeah,
It's almost legendary for tech.
it really is. And the biggest engine behind it, buybacks. Those large S&P 500 companies, many of them tech giants, they time the reopening of their buyback windows really aggressively right about now.
And that's just constant buying pressure.
Constant structural buying pressure. We're talking potentially hundreds of billions flowing into equities. It creates this tailwind that's just very, very hard for the market to fight against in the short term.
Okay, that influx sounds almost unstoppable. But here's a question. The NASDAQ has been on an absolute tear, right? Our research mentioned it's gone up for 7 months straight.
That's right, a record run.
Doesn't that kind of streak start to raise questions about, sustainability? Can it really keep going?
That's a very fair point, and it absolutely should raise an eyebrow. An eighth bullish month, which would be November, is definitely possible given the force of the buybacks. But 9 consecutive green months, that's basically unprecedented in the historical data. So the strong implication is if November does deliver the kind of upside we're anticipating,
December might be payback time.
or at least consolidation time, December is statistically much more likely to see sideways chop, or maybe even close down slightly as the market digests the gains before the new year.
Okay, that makes sense. Manage expectations for year-end. Now let's talk correlation. This was a really interesting part of the analysis you flagged, a critical driver comparing NASDAQ to the Nikkei.
Yes, the Nikkei correlation. This is a key reason for the high conviction on November upside for NASDAQ.
So tell us about it. Why does the Japanese index matter for U.S. tech right now?
It's about the divergence since the April 2025 bottom. That was a major cyclical low for many global indices. Since then, the Nikkei, Japan's main index, is up a very strong 18%.
Okay, 18%.
And NASDAQ.
NASDAQ is only up 9% over the same period.
Ah, okay, that's a big difference. 9 percentage points. It's a huge difference. That 9-point gap suggests a massive lag. It's an inefficiency between two highly correlated risk assets.
But hang on, why must NASDAQ catch up? I mean, they're driven by different central banks, different economies, different company earnings for the most part. Is that linkage still really that tight?
It's a great question. The argument from the data isn't that it's a perfect one-to-one lockstep always, but when divergences get this extreme over a sustained period like 6 months...
Capital starts looking for value.
Exactly. Global asset managers, they operate on relative performance. If one major index has literally doubled the return of a very similar risk asset, the one lagging starts to look really attractive. Capital flows towards parity.
Okay, so for NASDAQ to simply match the Nikkei's performance since April, where would that put the index?
The calculation targets NASDAQ at 28,000.
28,000. And from current levels, that's roughly?
That's about a 9% upside move needed just to close that gap.
Wow. Okay, 9% in a month. That still sounds like a lot.
It does, but remember the scale we're talking about. Trillion-dollar companies, massive buyback flows. The analysis actually called that kind of move a drop in the bucket in context.
Right. Perspective. And quickly, you mentioned NVIDIA earnings coming up.
Yeah, NVIDIA reports November 19th. There's sort of a market ritual around it, meaning historically the market tends to stay pretty supportive, pretty bid leading into that big event. You don't usually see major drawdowns right before a catalyst like NVIDIA earnings. It just adds another layer of support for the bullish view, at least for the first half of the month.
Okay. That all paints a pretty bullish picture for tech broadly. But now let's transition to what you called the single most data-driven setup in the whole analysis.
Yes.
The microstock thesis centered around the XLK ETF.
Right. This one is really fascinating, purely from an algorithmic perspective. So XLK, that's the big technology select sector SPDR fund. It's supposed to track the whole tech sector, right? Apple, NVIDIA, Microsoft, all of them.
Yeah, that's the idea, diversified tech exposure.
Except the deep data analysis shows something else. It shows that XLK's entire return structure, historically, is basically a carbon copy of Microsoft's performance alone.
Wait, seriously? Just Microsoft? Not Apple, not NVIDIA with its huge moves?
Primarily Microsoft. It seems MSFT acts as the main anchor, the primary driver, almost regardless of what the others do, week to week, month to month.
That feels wrong somehow. Why would that be? Why Microsoft over, say, the higher growth, higher beta names like NVIDIA?
Good question. The thinking is it comes down to liquidity and maybe predictability. Microsoft has this enormous stable market cap. Its volatility, while still there, is relatively lower compared to some of the other
And it's
giants.
easier to manage algorithmically.
Exactly. That stability makes it almost perfect for algorithmic tuning. If you're a large institution building an ETF that needs to be hedged easily, moved efficiently in massive size, you might tune the whole thing to your most reliable, most liquid component.
And that's Microsoft.
Microsoft seems to be that anchor for XLK.
Okay, mine kind of blown on that one. But if that correlation is so incredibly tight, where's the actual trade? Where's the opportunity now for November?
The opportunity is in another huge divergence that's opened up since that April 2025 bottom.
Similar to the Nikkei NASDAQ gap.
Very similar, but even more pronounced here. Since April, XLK itself is up a massive 77%.
Okay, 77% for the ETF. And Microsoft.
Microsoft is only up 61%.
Whoa, okay, that's a 16-point difference. 16%.
It's a huge spread, a massive inefficiency given that historical near-perfect correlation. And the market algorithms, they don't let these things persist for long. They have to resolve it.
And the bet isn't that XLK tanks?
No. The whole thesis is built on volatility deflation and buybacks supporting the market. The premise is that Microsoft must accelerate sharply to close that 16-point gap.
And conveniently, there's a technical pattern lining up on Microsoft's chart right now, too.
There is, yeah. It fits perfectly. Microsoft is showing an inside 2-month candle pattern right now.
Okay, like the VIX inside month,
Yeah.
but over 2 months.
Exactly. The trading range of the last 2 months is tightly compressed within the range of the month before that. It signals consolidation, energy building up, often precedes an explosive move.
So you take that technical compression.
Combine it with the strong November seasonality, the buyback floodgates opening,
And the massive 16-point lag to XLK.
and you get what looks like a perfect storm for Microsoft to play catch-up, and fast.
Right. So the math. If Microsoft just closes that current 16-point gap to where XLK is now, what kind of move are we talking about?
Just closing that gap implies about a 15% upside move for Microsoft from current levels.
15%. That's already significant.
It is, but that's assuming XLK just stays flat. What if XLK continues higher, as the broader market view suggests? Say XLK moves towards maybe a 90% return from the April low.
Then Microsoft has to follow based on the correlation.
It has to follow proportionally. And the
Correct.
extended target, based on that kind of move in XLK and closing the gap, it puts Microsoft at a truly staggering number, $650 per share.
$650. Wow. Okay, that's a huge call. That's like, what, 26% upside from here?
Roughly, yeah, around 26%.
That needs some serious institutional firepower to make happen, way beyond just average monthly returns.
Yeah.
What's the biggest risk you see to a target that aggressive?
Well, the main risk is always that the historical correlation breaks down unexpectedly. Or perhaps the buybacks don't come in quite as strongly as anticipated. Or, some unforeseen macro shock hits the system.
Sure, the usual caveats.
Right. But purely based on the data patterns, the historical correlation, the current divergence, the seasonality, it's strongly supported. I mean, look at Microsoft's history post-1987. Its average return just for November and December combined is plus 8.6%.
Okay.
Given the 16-point lag this year and all the tailwinds, that kind of accelerated catch-up to $650 feels entirely feasible within this framework.
That's a really compelling case. A powerful look at the untapped potential just within equities. Okay, so VIX down, liquidity up, drives capital into stocks. Let's see if that same risk-on mood is spilling over elsewhere. Let's shift gears smoothly now, maybe away from stocks for a moment. Let's dive into the setups you found for crypto and maybe gold, starting with Bitcoin.
Yeah, absolutely. Bitcoin looks positioned for its own major catch-up rally.
Catch up like NASDAQ.
Very similar theme. It's been consolidating for a while, really lagging the equity rally through late summer. But crucially, it's been successfully defending a key dynamic support trend line.
Okay, what's that?
It's basically a rising trend line that connects all the major lows since the cycle bottomed out. Holding that line is technically very significant.
So consolidation, holding support, lagging equities.
Yeah.
Sounds like potential energy building.
Exactly. It looks coiled for potentially a 30, maybe even 40% upside move. The target, based on the structure, comes out around $142,000.
Wow, 142K, that's a big number too. And the macro backdrop supports that kind of move.
The low vol, high liquidity environment we've been discussing, yes, it's conducive to that kind of risk asset rally.
Okay. Any words of caution needed in the crypto space? Things to watch out for?
Just a quick note on Ethereum. ETH, Short term, it also looks bullish, moving with Bitcoin. But as it gets closer to its all-time highs, there's a specific technical scenario involving its own inside 2-month candle that we need to watch very carefully.
Why?
Because that particular pattern, if it resolves negatively at the all-time high, could potentially trigger a major reversal. So ETH might be something to watch as maybe an early warning sign if risk appetite starts to cool off later.
Got it. A potential canary in the coal mine there. Okay, let's move over to commodities then. Gold, XAU USD.
Yeah.
You mentioned a very precise swing long setup here.
Yeah, gold's interesting. It's been in a clear, sustained macro uptrend for a while now. And the key thing is, it has consistently defended every single quarterly low since the bottom was put in.
It's defending the quarterly lows.
So the bias has to remain long. But it's contingent on defending the current quarterly low, which sits at $13,819.
$3,819. So if it breaks below that.
If that level convincingly fails, then the whole macro uptrend thesis is invalidated, at least temporarily. It would likely signal a much deeper correction is coming.
Okay, so walk us through the entry for the long trade then. You mentioned targeting a specific support center, not just buying anywhere.
Right. We're kind of anticipating one potential final sweep lower, a shakeout to grab liquidity below the recent lows. So the idea isn't to chase it higher right now.
Okay.
The entry targets a zone where there's typically strong institutional support specifically, where the monthly and quarterly opening prices converge. Those levels tend to attract a lot of resting orders, accumulated liquidity.
Makes sense. High probability zones.
Exactly. So the setup is to use a limit order to enter long just above that critical $3,819 quarterly low, basically trying to catch that potential sweep into the support zone.
Yeah, and the target.
The target would be an expansion back up towards new all-time highs, assuming that 3,819 T level holds. It gives a good entry with relatively tight risk control.
Perfect. Very clear. Okay, to really round out the global picture, let's just take a quick final look at Forex. You highlighted an interesting cross-pair correlation between the British pound, GBP USD, and the euro, USD.
Yeah, this is another one driven by those faster, often algorithmic linkages you see in FX markets, probably tied to big bank hedging flows.
And the relationship is?
It's pretty simple historically. If GBP USD takes out its low from July 14th.
Okay, so specific dates low.
Yes. If cable breaks that low, then EURUSD is almost algorithmically programmed, it seems, to follow suit and take out its corresponding low from around the same period.
And is one leading the other right now?
Yes. EURUSD is currently lagging. It hasn't broken its corresponding low yet, which suggests there might be sustained pressure lower on the euro to sort of fulfill that algorithmic requirement if GBP breaks down first.
Interesting. But the actual trade setup you identified here was a long on GBP USD. Why long if the correlation might point lower eventually?
Good point. It's because we spotted a really key untested level on the 3-week chart for GBP USD. It sits down at 1.30151.
Untested support on a higher time frame.
Exactly. Those often provide strong bounces, at least initially. So the setup is about anticipating a reaction, a bounce, from that critical 1.30151 level before any potential bigger breakdown happens.
Catching the bounce first.
Right. Entering long there with tight risk offers a pretty decent risk-reward ratio, about 2.2R, just playing for that bounce-off key untested support.
Got it. A tactical long within a potentially more complex picture. Okay, let's try and pull all these threads together now. We've covered a lot of ground. For you listening, what's the main takeaway? What's the core conclusion about the market phase we're actually entering right now?
I think the clearest message from the data is that we're entering a phase defined by probably decrease in volatility, but potentially quite high returns.
Lower fall, higher returns. Sounds good.
And that potential seems really concentrated in the equity markets for now. It's driven by those strong seasonal factors, the buybacks definitely, and these powerful correlation dynamics that are basically demanding catch-up moves.
Right. From NASDAQ needing to catch up to the Nikkei.
Exactly. And maybe Bitcoin needing to catch up to NASDAQ.
And definitely Microsoft needing to catch up to its own ETF, the XLK.
Precisely.
Okay, so we've got VIX deflation as the technical green light, NASDAQ accelerating towards that 28,000 target, and then this potentially immense untapped upside in Microsoft targeting that, frankly, staggering $650 level based on its weirdly tight link to XLK. It feels like the stage is pretty well set.
Yeah, the stage seems set for potentially a very profitable end to the year, especially in November.
So thinking about that structure, particularly the Microsoft XLK thing, I want to leave you with more provocative thought, something that kind of jumped out from the sources. We saw analysis suggesting that a huge multi-trillion-dollar complex index fund like XLK can have its performance almost perfectly mirrored, month after month, by just one single stock component, Microsoft.
Yeah, that correlation is uncanny.
So if market algorithms have become so sophisticated, or maybe so focused, that they can effectively tune an entire vast index structure to the behavior of just one, albeit massive and stable, stock, what does that really imply? What does it tell us about the actual complexity or perhaps the surprising, maybe even profound simplicity that might be underlying these giant global indices we all watch?
Hmm. That's a really interesting question. What does it imply about market structure?
Something to definitely mull over as you watch the volatility hopefully deflate and these potential moves play out.
A great question to end on.
This has been the Deep Dive, digging into the market outlook for November 2025. As always, we encourage you to explore these ideas further for yourself. Thanks for joining us, and we'll talk to you next time.